Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, welcome to Monday. When you take a look at equity markets, they continue to rise, records across the board again, particularly what we saw that on Wall Street. That is despite the US government shutdown.
Yeah, and I mean, I think we've spoken about it in the past, and it's been quoted frequently over the last week or so, is that equities tend to rally through these shutdowns. The 2018 to 2019 precedent, if you will, saw the S&P 500 rise 10% through that period for reasons totally unrelated to the government shutdown. Obviously, the big problem here is that we're not getting the typical data, which on Friday night we didn't get the non-farm payrolls figures, and who knows when this shutdown will end. There's the hope that maybe they'll get published at the end of the week instead. So we've got the markets flying blind slightly, which, a lack of information should in principle lead to marginally higher uncertainty and therefore marginally higher volatility. That hasn't materialized yet. The other big, maybe slight tail risk of this situation is that there has been these threats of, turning furloughed workers into, permanent layoffs, or at least in a large number of them. And that's when you start to talk about maybe the lasting impacts of this government shutdown being more than just a sort of a disruption, a short-term sort of demand shock, very modest demand shock, into something that could be, full of second and third order effects of, higher unemployment, lower incomes, less spending, less growth, and what have you. So those are the problems that the markets could potentially confront. But for the time being, again, just like history suggests, investors are looking through things, albeit, with a level of chagrin because of the impacts on the release of data.
Now, meanwhile, spoken about equities continue to rise, so too both gold and Bitcoin.
Yeah, Bitcoin hit a record high over the weekend, and I think maybe you could probably divide the gold and Bitcoin story into two different ones. To be honest, just because they haven't traded in a particularly strong correlation for say the last 3 months or so. There's been periods where they've been quite. Last week or so, that's a good example. But we have seen probably gold behaving a little bit more of a safe haven throughout that period for a number of reasons, whereas Bitcoin has fluctuated based on sort of more speculative activity. But there is that argument that Bitcoin is still a risk asset basically, and I think that argument's a pretty cogent one, and that it is a forward-looking indicator for equities, certainly an indicator of sentiment in the markets. And we are seeing these kind of signs of maybe a little bit of irrational exuberance emerging amidst obviously a lot of this talk about whether we're in some kind of a bubble at the moment. Certainly valuations are high. Whether it sort of qualifies as a bubble or not is probably a subject of debate. But yeah, that 125,000 level was breached over the weekend. It'll be interesting to see if that carries through to the start of the week. On the flip side of things, the gold story is very much tied back to the prospect of interest rate cuts in the United States. Clearly, that kind of private payrolls report that we got last week, indicating that the US labour market might be shedding jobs, boosted the odds of an October rate cut to about 100% and a December cut to about 90%. You've got the markets also pricing in a sub 3% federal funds rate at some point next year. So gold's really getting a boost off that, as well as the same sort of institutional risk and fears about fiscal policy going forward as well. So again, simultaneously, the markets are kind of looking to hedge against certain risks when it comes to US economic activity, and then also Bitcoin being a bit of an expression of perhaps speculative behaviour. Some interesting signals there for traders to digest.
And elsewhere in the commodities, with a focus on oil, it was down about 8% last week. OPEC Plus looking to increase supply yet again.
Yeah, November, and effectively, there's this very strong signal from OPEC at the moment that is, certainly prioritising market share and volumes over price and revenues. And there's perhaps a number of reasons behind that. Some of it might be an appeasement of the Trump administration who wants lower oil prices. Arguably, there's the view that they want to make sure that they can continue to put sort of pressure on the margins of big US energy producers who are seeing a much more favourable regulatory landscape going forward from the Trump administration. Then there's, the internal issues within OPEC, where some of those larger players are, trying to punish those countries that were and members of the cartel that weren't so compliant over the years of, supply restrictions, and the Saudis and what have you, who have very low marginal costs and very low break-even prices relative to other members of the cartel, are looking to maybe again claw back some of that market share. But nevertheless, whatever the sort of balance of reasons are, there is clearly an oversupply building in the market, and OPEC are ignoring that signs of a glut in a fairly precarious, perhaps, demand environment. Obviously, we're talking a lot about potential US economic weakness going forward as well. So we went through what was a pretty key level, and we kind of priced. Most of our clients trade the West Texas Intermediate contracts more than anything else. It was a pretty key level around 61.50 that broke last week. We're at that now. There is a lot of talk about, $50-something oil out there in the market. I don't know if that's a contrarian signal or not, but nevertheless, the supply and demand imbalance is certainly pointing in a bit of a glut, and it's the reason why we have seen that kind of big sell-off in oil prices over the last week or two.
Now, what are you seeing on the currency front, Kyle? In particular, have we seen much movement from the yen, given we've had more political upheaval in Japan with the prospect of the country's first female Prime Minister?
Yeah, so the LDP election seems to have resulted in a bit of a weaker yen, and that's largely due to expectations around fiscal policy. This was being priced in for a little while, but there was the sense that we would get a victor of this sort of leadership campaign that would be quite, I suppose, accommodative in terms of fiscal policy. Bigger spending to come in the way, or at least sustained spending to come down the pipeline, and then that's going to sort of feed upward risks on inflation, and also maybe continue to put upward pressure on Japanese bond yields. Which, if we have, if you look at some of the auctions that we've seen recently, and just certainly some of the price action, is simultaneously we get kind of fairly persistent inflation, as well as the BOJ stepping back from the market as it kind of still embarks on normalizing its balance sheet, that it's having an impact on demand for JGBs, and that's kind of causing that quite ominous mix of a falling bond market as well as a falling currency. So this could all be kind of curbed if the Bank of Japan was a little bit more hawkish, and I would potentially argue a little bit more muscular and responsible when it comes to the monetary policy side of things. But on Friday, we also had Governor Ueda suggesting that hikes are on the way. That's nothing new. We've heard from the BOJ for a long time that they think policy settings remain in accommodative territory. Real yields remain, very, very negative. So in principle, that should be continuing to put upward pressure on inflation. And without, more or less, the Bank of Japan stepping in and suggesting that it'll try and take some of the steam out of inflation, take some of the steam out of the Japanese economy, this fiscal spend is actually, a negative for the yen. So if the yen come off, that will probably manifest in a stronger Nikkei today. And there'll probably be knock-on effects to the broader G10 currency complex as well. So, yeah, pretty significant development over the weekend in Japan, and one that's certainly moving markets at the outset this week.
And Kyle, back to where we began, what's your outlook as far as equity markets? We're expecting another positive start here locally. I mentioned those records we saw on Wall Street, and given the US reporting cycle, we're almost at reporting season again.
Yeah, we are. And I think, there's really two things that are kind of boosting market sentiment going in from a fundamental perspective going into this final quarter, which is interest rate cuts, which you've obviously already discussed, and the fact that Magnificent Seven have a track record of exceeding very lofty expectations, and the hope that that will kind of happen once again, that the upside risks for some of these companies outweigh some of those valuation fears and what have you. There is this persistent discussion about to what extent, like I said before, we're in sort of a frothy, maybe even slightly bubbly market. There's enough evidence to suggest that things are very, very richly valued. Points of trivia, if you'd like, the trailing price to sales ratio for the S&P 500 remains at levels that we've never, really seen before. I think the other one's EBITDA versus enterprise value at sort of record highs. We're at levels that we haven't seen since the pandemic, since sort of for the trailing price to earnings ratio. So all these things that suggest things are very richly valued. Does it qualify as the kind of irrational exuberance you might see in a bubble? Perhaps investors are very, very much heavily allocated. There's all these stories about the revolutionary nature of AI and why this time is different. Sometimes that's a bit of a red flag too. But nevertheless, what can be said, I think, is with valuations up here, if we get negative surprises to the market, that could be quite painful. But in saying that too, there's a lot of momentum behind this that, as the, famous quote goes by Keynes, the markets can remain rational longer than investors can remain solvent. So it's kind of like a buy the break market in the short term. If we get continued exceeding expectations from some of these tech stocks for earnings season, we'll continue to see breakouts. That'll feed the momentum, even if it does come in a market that's increasingly richly valued.